Hey, it's Joshua here with another edition of Mortgage Clarity. And in today's edition, I'm going to go over an announcement that just came out by FHFA, who oversees Fannie Mae and Freddie Mac. Now, these are big changes that are going to have an impact to borrowers that are looking to use conforming loans to either purchase a home or to refinance a home. And it's going to change how they actually price risk into your interest rate. So you want to kind of pay attention to this. I'm going to go over a high level kind of overview. But if you got specific questions, as always, feel free to reach out to me. And of course, if you're finding this video helpful, do hit the thumbs up and the subscribe button. So what are we talking about when we say interest rates are about to get more expensive or potentially more expensive for some borrowers and cheaper for others? Well, what it has to do is it has to relate to how Fannie Mae and Freddie Mac assess risk to different parts of the profile and how that gets priced into the interest rate. So I'll try to back up real quick and give you a simple example. On a conventional loan with 25% down with high credit scores, you have a set rate. But as you start to put lower down or your credit score drops, at some point, the investor finds that to be risky, investor being Fannie Mae and Freddie Mac. And so they're going to charge you a little bit more for that interest rate because either you put less money down or you have a lower credit score or a combination of both compared to a different borrower. Another example would be when you look at what the cost of a given interest rate is for a primary home versus a secondary home versus an investment home, you will see that that same rate has a different cost given everything else being the same, simply because of the purpose of the loan is considered a higher risk. So some of the changes that are happening now, we will actually see for some borrowers with lower credit scores and even lower down payments that the cost of these adjustments will be more favorable, i.e. cheaper when these changes take effect. For other borrowers, we might see that they're going to be more expensive. And I say on a whole, for more borrowers, we'll see a negative change to the pricing of rates after this takes effect than prior. So without the market changing at all, you're going to see the pricing of the rate change. So for some examples is in the past, Fannie Mae and Freddie Mac have pretty much treated like a 740 and higher credit score in most situations as top tier, with no differences. With these new changes coming, they actually now have additional tiers from 740 to 760, 760 to 780, and then over 780. And they're adding these tiers because prices at 740 credit score are actually going to get worse after these changes. So you're going to just have to have a little bit higher credit score under these same scenarios to get that better rate. Some other changes that we're going to see that's going to be very impactful for borrowers looking to do refinances is that they're going to make some additional changes to just the hits for doing a refinance. And there's lots of different areas for this, and I won't go into it all, but just to know that for most borrowers, the fact that you're going to do a refinance will be considered riskier and have negative pricing impacts to the rate going into the future. Other changes is currently when it comes to things like debt to income ratio is very important in determining whether or not you qualify for the loan. Can you afford the additional debt? But it didn't really have an impact in your interest rate. It could potentially impact mortgage insurance if you had that, but on the interest rate side, did not have an impact. With these changes that are coming down the line here, which will take effect in about March, you'll actually see these priced into lenders prior to that because the lender has to be able to get the loan sold to Fannie Mae before these changes. So you can expect to see these changes come in middle of February, end of February. But now debt to income ratios will actually be a factor. So when you have over a 40% debt ratio, you're going to have a different rate than somebody at 39, at 45, a different rate than 40, and so on and so forth. So these are some big changes that are going to have an impact. Again, for some borrowers, particularly borrowers looking to purchase with lower credit scores, you're going to see an improvement to pricing. However, I think they're funding that improvement by going after and actually penalizing borrowers that were otherwise considered top tier, and their rates are going to get a little bit worse to help offset that risk that's going to improve for the other end. So that's how you have it. So good or bad, just depends on where you're at in that spectrum. Again, there's lots of other changes that are going to happen to 2 to 4 units and so on. But these are some of the big changes to keep aware of. So if you're working with a lender and all of a sudden you wake up and your pricing's different, this might be one reason that happened. The change was there. So again, if you have questions, reach out to me. If you want to know how this is going to impact your ability to buy or your ability to do a debt consolidation or refinance loan, again, feel free to reach out to me. Information is down below. Be happy to answer those. Thumbs up if you like it, share with your friends, and have an excellent day.